If a physical brick-and-mortar building does not vanish when it changes hands, how exactly did transferring the ownership of existing properties manage to decimate London's available housing supply? It is a fundamental paradox of the property market. We intuitively assume that selling a home simply changes the name on the deed, leaving the overall equilibrium intact. Yet, examining the long-term mechanics of the capital reveals a distinctly different reality. The answer lies in the systemic shockwave generated by the Housing Act 1980. This legislation introduced the Right to Buy scheme, a policy allowing council tenants to purchase their homes at heavily discounted rates. On paper, it was an elegant mechanism for wealth distribution, designed to instantly transform a generation of renters into a property-owning democracy. The mechanic was simple. The longer you lived there, the cheaper the property became. The initial uptake was staggering. According to historical government records, within the first decade of the policy's implementation, well over 1 million council properties were eagerly sold off across the UK. In London alone, individual boroughs saw tens of thousands of units transition from public assets to private equity almost overnight. The sheer volume of transactions fundamentally altered the balance sheets of local authorities, transforming the capital's real estate landscape at an unprecedented velocity. But the immediate success of these sales masked a critical structural flaw. When a council house is sold into private hands, it is permanently removed from the subsidised social housing stock. That property will never again house a low-income family at a sub-market rate. The flow of affordable inventory was abruptly severed, turning a cyclical public resource into a static, privately held financial asset. The mathematical failure occurred on the replacement side of the ledger. Treasury rules at the time explicitly restricted local councils from reinvesting the entirety of their sales receipts into building new homes. Instead, a significant portion of the capital had to be used to pay down historic municipal debt. Councils were forced to sell off their most valuable assets at a steep discount, while simultaneously being financially handcuffed from replacing them. The compounding effect of this restriction on the capital has been severe and unrelenting. According to Greater London Authority, data analysing stock changes over the past 4 decades, the net loss of social housing in London numbers in the hundreds of thousands. The pipeline of new council builds effectively flatlined by the late 1990s, leaving a permanent, widening deficit in the city's housing inventory that developers have never managed to fill. When that social safety net collapsed, the underlying human demand did not evaporate. The population of the capital continued to grow, but the lower rungs of the housing ladder had been effectively kicked away. Those who would have historically been housed by the local authority were instead pushed directly into the open market. This created an artificial, heavily concentrated surge in demand for non-subsidised accommodations. This migration of demand acted as the primary catalyst for the explosion of the private rental sector. Without the buffer of public housing, private landlords eagerly stepped into the void. A housing ecosystem that was once neatly divided between stable owner-occupiers and secure council tenants rapidly fractured, giving rise to a highly competitive, entirely deregulated tier of private rentals that now dictates the living standards of millions of Londoners. The great irony of this policy shift is the current ownership profile of those original council estates. A significant percentage of the properties sold under the 1980 legislation did not remain in the hands of the working-class families who originally bought them. Instead, as those initial buyers aged, downsized, or moved on, the properties were systematically absorbed by property investors and corporate buy-to-let landlords. Current market analyses reveal the rather stark, uncomfortable reality of this long-term transition. According to recent English housing survey estimates, up to 40% of all ex-council properties sold through the right to buy scheme are now being let out privately. In many inner London boroughs, local authorities are now renting back the exact same properties they were forced to sell decades ago, but at triple the monthly cost to the taxpayer. You can see this dynamic playing out aggressively in boroughs like Tower Hamlets and Barking. In these areas, the transition of mid-century estate blocks into private rental portfolios has completely redefined local microeconomies. The architectural footprint remains identical to the 1970s, but the financial mechanics governing who gets to live inside those concrete walls have been entirely privatized, driving localized inflation and displacing long-term communities. To understand how investors capitalized on this stock, we must look at the financial tools of the era. Favorable loan-to-value ratios, or LTV, allowed landlords to heavily leverage their capital to acquire these ex-council flats. Furthermore, before recent punitive changes to stamp duty land tax, or SDLT, a tiered tax on property purchases, investors could accumulate vast portfolios of these cheaper units with minimal upfront friction or government penalty. As investor capital flooded into former social estates, it triggered aggressive yield compression. Yield compression occurs when the capital value of a property rises faster than the rental income it generates, squeezing the investor's percentage return. To maintain their profit margins against rising acquisition costs, landlords were forced to aggressively hike rents, fundamentally decoupling the cost of living in these properties from local wage growth. The shadow of SDLT surcharges and tighter lending criteria eventually cooled the buy-to-let frenzy, but the structural damage was already permanent. The echoes of that initial market phase still resonate through every tenancy agreement signed today. The properties had already been commodified, locking in high capital values and guaranteeing that the private rental market would remain structurally undersupplied and heavily overpriced. We see the terminal velocity of this trend in modern pricing metrics. According to ONS data from the third quarter of 2023, private rental prices in London experienced their highest annual percentage change since comparative records began. This is not merely a symptom of recent interest rate hikes or short-term inflation. It is the mathematical endpoint of removing a massive subsidized housing buffer from a high-demand global city. The divergence between the 1980s buyer and the modern tenant illustrates a profound generational wealth transfer. The original policy allowed an entire demographic to leverage public assets into private equity, which they subsequently passed down or sold to investors. Today's renters are effectively paying the dividends on that historical wealth transfer, trapped in a highly competitive market where supply cannot mathematically meet demand. Ultimately, analysing London's current property landscape without understanding the legacy of the right to buy is like trying to read a balance sheet with half the pages missing. The housing crisis is not simply a failure to build new homes today. It is the lingering, systemic consequence of a deliberate policy choice that permanently dismantled the city's foundational housing supply, leaving the private sector to profit from the resulting scarcity.